Good morning and welcome to the Killik & Co market update. It's been another choppy week for markets, although we did have a very strong start to this week. The S&P 500 briefly moved into positive territory for 2020 so far, and the NASDAQ Composite actually hit a new record high of over 10,000. The NASDAQ Composite is very heavily exposed to technology, and it's filled with the types of companies that are thought to be benefiting from this lockdown situation. For example, cloud computing, video conferencing, and gaming. So that's why that particular index has performed so well. At the moment, there's a lot of debate around whether or not the global economy will go through a V-shaped recovery, or perhaps a slower, more U-shaped recovery. Time will tell, but for the time being, it's certainly true that some stock markets have already experienced a V-shaped recovery, as you can see by this NASDAQ chart here, which shows a very clear V shape. Although we had this strong start to the week for stock markets, things have weakened as the days have gone on, and Wall Street was actually down by 6% yesterday. The reason being some negative commentary from the Federal Reserve, who said they do not expect to raise interest rates in the US until the year 2023. So that really shows that the central bank is well prepared for a much slower economic recovery. There are lots of negative headlines this morning saying that the UK economy shrank by over 20% in April. What does this mean? Well, it's the latest data showing our GDP, or our gross domestic product. And this is calculated by adding up the value of all goods and services produced within the UK within a specified time period. In April, the entire country was in lockdown. Factories were closed, pubs, restaurants and hotels were closed, so it's not surprising that the value of our output was much lower during this month. It's not to say that a lot of this activity won't bounce back, as and when these businesses are allowed to reopen. And it certainly doesn't mean that the value of our economy will permanently be 20% smaller. And in fact, we've already seen quite an improvement in the data for May and June because lockdown measures were eased during those months. And in fact, the FTSE 100 is up this morning, so that really shows that UK investors are not overly concerned or shocked by the latest GDP numbers for the UK that were published this morning. One positive side effect of this lockdown situation has been our declining use of fossil fuels. Data out this week showed that the UK has now gone for 2 months without burning any coal for electricity generation. Renewable power is becoming an increasingly significant proportion of our overall electricity generation. If you have a look at this chart here, you can see how the UK has generated electricity going all the way back to 1998. This chart takes us up to the end of 2019, but the trends that you can see on the chart have very much continued since then. If you have a look at the orange and the grey parts of the chart, you can see our use of coal and renewable power. Our use of coal has virtually died out, and it's largely been replaced by renewable power. What's also quite interesting is the blue line in the middle, which shows our use of natural gas. As you can see, we're very much still dependent on natural gas, and this isn't really showing much sign of slowing down. Natural gas makes up a very significant proportion of revenue for the oil majors, such as Royal Dutch Shell and BP. So for the time being, while we're still so dependent on natural gas, these companies will remain a very important part of our economy. Moving on to have a look at next week, we've got results out from utility companies, National Grid and SSE. That's it from us. Have a great weekend, and we'll see you next Friday.